Hey, good afternoon and welcome. I am Matt Price with the Price Group. We will be talking creating retirement income for retirement, an exciting topic for a humid day here, October 12th in Houston, Texas. So glad you are here. Make this interactive. We can receive some questions via the question portal. Email us any questions offline if you have any, but our goal with this series is to provide education for those of you that are approaching retirement. Some of you may already be in retirement, and we want to act as a sounding board, a fiduciary-centric sounding board along the way. Who are we? Randy, he would try to tell you he's my older brother. He's actually my father. I am Matt Price. We've worked together for 12 plus years. Family owned and operated, serve as a fiduciary. We have a retirement niche. We actually sat down and did the math here recently. 82+% of our clients are retired, and the other 18 or so percent of clients are on the verge of retirement. So this is really all we do. We like to say, if you have a heart issue, you probably don't want a doctor that does hearts on Mondays, big toes on Tuesdays, or gallbladders on Wednesdays. You want a doctor that is solely focused on cardiovascular work. We think the same holds true with retirement planning. You should look for someone that has a real specialty in that area. About our firm, Steward Partners, it's based off the biblical definition of stewardship. We're not some small shop that just set up with over 26 billion with a B dollars under management at the end of last year. We think one of the real key pieces of information for your consideration is we're not owned by a bank. So we're an employee-owned firm, and we use Raymond James as our back office, our client custodian, actually introducing 2 different new custodians for clients here in the next few months. But we've been really happy with Raymond James and excited to continue to partner with them. A little bit about us. Randy and I both went to Wharton to receive our CIMA, Certified Investment Management Analyst designation. We're both certified financial planners. We actually have a third financial planner on the team as well, Maddie Kearns, who's a big part of what we do. Randy's been really humbled to receive awards from Barron's, Forbes, Financial Times over the years. And if you've been with us for any amount of time, you probably are familiar with our Wealth Coach podcast, been quoted in CNBC, some other places over the years as well. But here's what we're going to look at today. We're going to warm up our brains. We're going to look at the markets. What are the top 5, we think, risk of retirement? How can we mitigate those risks? And then what does it look like to financially live well in retirement? So kind of ask you a rhetorical question. Why did you attend this webinar? We think everyone and anyone are looking for the 3 C's: comfort, confidence, and clarity as it pertains to their financial future. And we don't have a crystal ball that's going to tell us exactly what the stock market or the bond market are going to be doing here in the next week or the next month. But what we do have is a fact-driven investment process, and also equally, if not more important, a planning process that gives clients comfort, confidence, and clarity about where they're going. So we are excited to jump in, but first let's warm up our brain. What was the annualized total return for the S&P 500, the overall stock market, in the decades of the 1930s? 0, and then we have a few negative options, 1 positive options. Obviously, we all know what was happening in the 30s, but the answer is 0, which you probably have heard of it referred to as the lost decade in stocks. Similar thing happened from 2000 to 2010. Stocks went up, they went down, they went up. They essentially for 10 years moved sideways. But let's look here at the markets. A quick overview. This is a look back to 1900 for the overall stock market. Green is good, red is bad. Not telling you anything you don't already know. But bull markets tend to last anywhere from 17 to 25 years. And so in our humble opinion, we have not ended the current bull market. We do think this is a pullback in a overall bull market. Why do we think that? Well, in our humble opinion, This bull market started spring of 2009, which we think there are at least a few years left to go of expansion here domestically in the United States. So is the economy healthy? This is a question we're answering a lot for clients, and it's not as clean cut as we would hope. We think there are some what we call leading indicators, things that we monitor to help us say, is a recession coming? You look at the Webster definition of a recession, 2 straight quarters of negative GDP growth, we would be quote unquote technically in a recession. But we did a webinar for clients just last month where we discussed that in more detail. A big component of that negative GDP had to do with lack of government spending. So we think the consumer, we think businesses as a whole are not necessarily operating as if they're in a recession, but you can make a compelling argument that we are currently in one. But here are a few of the metrics we look at that are leading indicators that help us determine if and when a recession is coming. And these things help guide our macro outlook on if we need to make changes to any investment models for clients. So it's our opinion we're not in one now, but 2023 could be another story. We're probably somewhere in the range of the high yellow, low red on our interest rates restrictive or just neutral today as we speak. We do think there is a probability of a recession coming next year. We do not think it's going to be nearly as severe as we experienced in 2008, 2009, or during COVID in 2020. Our best guess would be that it's a more mild recession, and that's not just us putting our finger in the air and feeling which way the wind goes, but the consumer as a whole is a lot more healthy than they were going into 2008, and businesses as a whole are a whole lot more healthy than they were going into 2008. And we don't have any real asterisk next to any item like the mortgage crisis. That was one of the main reasons for the whole financial crisis back in 08 and 09. So probabilities are increasing, has to do with how quickly the Federal Reserve will stop increasing interest rates. And if you know the answer to that question, please let us know, as we would like to hire you. So all joking aside, government spending is not healthy. Probably not saying anything that each of you on the call does not already know, but there has been actually some, I would say, progress here in the last 9 to 12 months from a standpoint. The government has said that they're going to stop buying as many bonds. Their goal is to now reduce the money supply. Inflation really tracks very closely money supply, which is typically a leading indicator by anywhere from 9 to 15 months. So you started them to really see them change course holiday season of 2021. So we're coming up on the 1-year time period. And so it's our best guess that inflation does start to roll over here in the next 3 to 6 months. But time will tell if that is right or not. We put together a total of 7 different potential game changers as it pertains to inflation. And I want to spend just a minute focusing on the first one here, the normalizing money gross supply. This is the most important in our opinion. And when we look back at the 70s, the 80s, with some periods of high inflation, inflation really tracked the money gross supply closely. And so we think this is the best gauge for if and when inflation will start moving lower. Like I said, it's a little bit of a lagging indicator on the inflation side of it. And we started to see those numbers move lower end of last year. Inventory growth is higher. Auto sales or auto prices, especially the used car sales, are moving lower, which is going to help with the inflation numbers. Freight costs are way down from the peak last year. Semiconductors, fertilizers, other economically sensitive commodities are also moving lower. So there are some, I would say, tailwinds for inflation to move lower, but how quickly it happens, Mr. Powell, he doesn't know. None of the other Fed chairs know. It's speculation at this point, but we do think there's mounting evidence that inflation will start to roll over. So will the Fed policy be just right with raising interest rates? Maybe, question mark. You've probably heard the quote unquote soft landing talked about. That's very optimistic. The hard landing would be us entering a recession. Our base case is that we enter a recession sometime next year, but it is a mild one. So that brings up a good question we get a lot on, well, Pat, Randy, if you think a recession is around the corner, why are you not selling our stocks and putting the money under the mattress until the recession ends? And I'm sure most of you on the call understand this, but just as a review, the stock market is a leading indicator, meaning that the stock market is going to move lower before typically the worst news hits. And historically speaking, the stock market will start moving higher before everything looks quote unquote good, or the dust has settled, is what a lot of clients will say. So we think that overall, the market is already priced in a mild recession, but the big kicker still is, where do interest rates go from here? A look back at, we put the word safe in italics, safe bonds. Here are 3 periods of time, and we'll work left to right. The one on the left from 1928 to 1940, these are real rates of return. So real means adjusted for inflation. You had a great 12-year period owning T-bonds or T-bills from 1928 to 1940. But you started investing in T-bonds or T-bills in 1941. For the next 40 years, after you adjust for inflation, you actually lost money. So you go 4 decades, you actually back up with your purchasing power, but then move forward to 1982 through the end of last year. You have a 5% inflation adjusted return for T-bonds, a little bit lower for T-bills. The moral of the story is this: interest rates typically work in 40 to 50-year cycles. And history typically does not repeat itself, but it often rhymes. We could be in a secular period where interest rates do start to trickle higher for 10, 15, 20 years. And if that's the case, we need to have a bona fide process for how do we invest money, our non-stock money, in a period like that. So we're big believers in individual bonds. CDs at banks are now yielding a whole lot more than they have for the past 10 plus years. Preferred stocks, floating rate bonds, fixed income alternatives can make a whole lot of sense for certain accredited or qualified purchasers. So we have a few tools in our toolkit, but what we've done for most clients is we're not just owning bonds and, oh boy, I hope interest rates go back down so the bond prices go up, but we have a real recipe effect on how we're going to produce income and do it with less interest rate risk than the overall bond market. So where do we go from here? We think when we look back at history, when you've had a pullback like we've had of 25+% this calendar year, when we project out for the next 12 months, it's typically been a positive period for stocks. When you project out over the next 2 and 3 years, it's been even more positive. So we don't know exactly when the bottom is. We think it's kind of silly to try to time the bottom. No one knows that for certain. But what we can say is we think we're closer to the bottom than many might talk about on TV. So that, and then also typically the last 3 months of the year when it's a midterm election are positive. It's a positive quarter during midterm elections. So here are the top 5 risks of retirement. And by the way, we're 15 minutes in. Our goal is to have you out of here on time. Be done here by 3:45 or so. But risk number 1, longevity. The old saying, the longer you live, the longer you're expected to live, is very true. A married couple, you have a 47% chance for at least one spouse living to age 90. And I mean, that's, for, in my humble opinion, an eye-popping figure, where we used to think of 90 as being really, really old, but you're seeing more and more retired couples make it to and actually past that 90 threshold. So the point is, we need to plan for a long retirement, even if you don't think you're going to make it that long. Risk number 2, inflation. Inflation in retirement, we call it the hidden tax. This is a good thing to think about. The rule of 72. You maybe have heard of it when we talk about how long does it take your investment portfolio to double. Take 72 divided by your average investment return, call it 7.2%, and your investment portfolio will double every 10 years. But this also works for inflation. Take 72 divided by your rate of inflation, call it 3%. Your cost of living doubles every 24 years. You say, nah, that's not too big of a deal. Well, inflation being, depending how you look at it, let's call it 6%, 72 divided by 6, every 12 years, you're going to see a cost of living double. So we don't think that inflation stays as high as it is for the next 6, 8, 10 years, but it is something worth noting that we need to plan for in retirement, that expenses have been, are currently, and probably will continue to move higher. The third risk, market performance. And this is something we like to talk a whole lot in detail when we put together a live well plan for couples that are on the verge of retirement. But the highlights are this: the 2 boxes on the left-hand side here, these are while you're in the accumulation phase. So before retirement, or for those of you that are still working, you currently. And the overall kind of punchline is the order in which you get your returns while you're still working, it does not matter. So if you compare the top and the bottom box, you start out with a bad return in year 1, you get 7% rates of return from years 2 through 9. In a good year, in year 10, you start with $100,000, you end with $188,000. If you do it in the opposite order, while you're still working, down to the penny, you have the exact same dollar amount. However, in retirement, the sequence of returns has a dramatic effect on how your portfolio will survive or not survive. Where in our first example, the negative return in year 1, you're running out of money somewhere between years 9 and 10. However, if you flip those upside down and take a good return up front, you have over $52,000 left at the end of year 10. So the order you get your returns in retirement really matters. What that means to you is this: we think you should be using what we call Monte Carlo simulation, where we're actually showing you retiring 1,000 times and going through retirement 1,000 different times. And that is going to put the law of large numbers in your favor, statistically speaking, mathematically speaking, and also historically speaking. So kind of to continue with that same thought, market performance, let's say you were taking 4% out of your portfolio and the market is down 20%. So just for perspective, so far this year, stocks are down, we'll call it round numbers, 25%. The bond market is down, round numbers, 15%. So depending on your blend of stocks versus bonds, this 20% for this calendar year is not necessarily far-fetched. But with that being said, the point of this slide is you don't need 20% just to get back to break even. You need a 36% rate of return to get back to break even, including some inflation, including what you've drawn down and also taken out of the portfolio. So retirement risk number 4, investing without a process with a capital P. It's an emotional game when you are investing your own money and trying to make good long-term decisions. Here, this is a look at the S&P 500 as the grayish line. What you can see here at the end of 2002, and then also end of 2008, early 2009, when stocks were at their low, you saw the most outflow into stocks, these bluish pieces are when people are selling or buying. And you see that people overall have sold at the low, the worst possible time. And back in 99, the highest inflows was back at end of 2000, early 2000, end of 2000, 1999, when the market had had a great 10+ year run. It's probably not when we should see a ton of people adding money to the overall market. So the flow is typically wrong, is the unfortunate truth when we look back at history. And that is what happens when you're investing without a process. The fifth risk being healthcare. It's totaled here by Fidelity that the average couple will spend $315,000 in healthcare and medical expenses throughout their retirement, which is a real number. Now, some of that will be taken care of by Medicare, not all of it, but we need to have a game plan in place with each and every family's Live Well plan on how we're going to deal with this healthcare bill that is facing really all families that are approaching or in retirement. So how do we face these uncertainties? We think having a retirement roadmap is one of the main pieces of advice we can offer. We call this our Live Well plan. We call it that because we want our clients to live well, but we also were just kind of cheesy and we couldn't come up with a better name. But we're trying to answer the questions: how much can we spend? How long will our money last? What rate of return do you actually need? And then how much income do you need to produce? That's a key one. And what we have found this year for clients, the clients who know that they're just living on the income of their portfolio, they're a lot less worried about drawdowns in the market than the client who's needing to sell money every year to fund their lifestyle. So everything we do is income driven, and we do that because we think retirement, one of the keys to success is income, income, income. And we'll talk a little bit more about that here later. Step number 2, stress test your portfolio. We do this on a quantitative but also a qualitative basis. Can you emotionally handle the drawdown like you're seeing this year? Or what if stocks go down even more? Can you ride that out emotionally, sleep well at night, knowing that you're going to be okay? But can your retirement plan recover from a drawdown like that? And a lot of times the answer is no, depending how old you are, how much you're spending. There's a lot of caveats that go into that answer, but that's what we essentially are solving for when we're creating this customized, personalized Live Well plan for each family. Love this quote here by Benjamin Graham. Investment management is the management of risk, not the management of returns. We are seeing that play out this year, and people are waking up and realizing that that's a true statement after a great decade of stock market performance coming into 2022. Step number 3, maximize your Social Security benefits. There's a lot of different ways for a married couple to file benefits, actually over 80 different ways to do that. But what we'll do is we'll help optimize the best way to file for benefits. And if we need help, we have a bona fide Social Security specialist that we can put you in touch with to answer any granular details. The questions typically become a lot more confusing if you or a spouse has ever worked at in the TRS system, the Teacher Retirement Savings System. There's some more complex rules surrounding how Social Security benefits should be filed for at that point. We never want the tax tail to wag the dog, but income tax efficiencies are really important. And so this is not a holistic look at what we are doing from an income tax efficiency standpoint for clients, but we wanted to give just 3 quick examples of what this can look like. Qualified charitable distributions, a QCD, you can use that for up to $100,000 of your required minimum distribution each year. RMDs actually start at 72, but you can start doing this QCD at 70.5 as the law currently reads. Gifting of appreciated shares of stock is a great way to dodge some capital gains tax. If you give money directly to a 501c3 organization, when that charitable organization sells the stock, they do not owe any capital gains tax. And then bunching deductions sometimes becomes a lot more important for families in retirement when compared to when they were still working. And so we work with CPAs to see if that makes sense, when and how to pay property taxes and some other things that can move the needle on that metric. So, and the last step is cash flow planning. Is 3% the new 4%? That's a catchy phrase that there was a white paper written about a few years ago, but the 4% rule is something that probably many of you are familiar with. But that's using information from the 70s, the 80s, the 90s, and all those decades had higher interest rates compared to now. So one could make a fairly compelling argument that 4% is a whole lot more than it was when that study was done. Just from a standpoint, your non-stock piece of the portfolio, bonds, are earning less when compared to the historical norms. So that's a big piece of the Live Well plan. How much money is your portfolio producing, but also how much money can you spend in retirement and still be comfortable to meet your goals. Here's a look at each decade on how much dividends accounted for the total return of the stock market. And you see the total is just right around 40% there, dating back to 1930, which is a material number, not a rounding error. And so we think dividends are very, very, very important from a standpoint moving forward. If investment returns are more muted, they're going to be even a bigger portion of that total return for you in retirement. But at the same time, we think retirement's a cash flow driven exercise. And if that's the case, having regular, reoccurring, and hopefully increasing income is really going to help you during periods of market volatility like we're experiencing so far this year. But here's a look at why we love, or we call our strategy dividend growth. And we call it that because we're looking for the companies that we think can grow their dividends year over year. But this is a look at the compounded returns from 1986 to 2020. And the kind of chart speaks for itself. The best performers actually have been the companies that can not only pay, but increase those dividends year over year. And you see the worst performers are actually the dividend cutters. So if we ever get a whiff of a company cutting a dividend, they're kicked out of the portfolio immediately. Happy to report we had no dividend cuts in 2020. And when we look back at 2009, we actually had a dividend income increase that year as well. Planning for long-term care is really important, something that we're asked about at least on a weekly basis. 2018, the average care was for about 3 years. It's increased, this is last year's data, but to 3.5 years, which is on a percentage basis a big jump. And the cost for these facilities continue to move higher. So our last step, consider hiring an advisor. I said earlier, we think you should consider hiring someone that's a quote unquote retirement specialist. And you can see here that chart on the right. Because of emotions, the average investor has just overall underperformed homes, bonds, the overall stock market, high yield bonds, REITs. And the closer you get to retirement, the more costly these mistakes can become. So we're fair game for any and all questions from a standpoint putting together this Live Well plan. It's not a salesy experience. We don't have any products that we're trying to sell, but it's more of an educational experience where even if we don't end up working together, typically clients or couples will leave saying, you know what, I learned a couple of things that I can take with me moving forward. But let's spend 2 or 3 minutes looking at our process. We think you need more than just an investment guide. We have track records that we can talk about in detail on the fixed income side, the stock side, And we think we've done a pretty good job of that over the years. But in our humble opinion, the real value add that we offer is pulling everything together: the investments, the retirement planning, the tax planning, estate planning, cash flow analysis, if there are any insurance needs. And love this quote by Mr. Graham, Warren Buffett's mentor: the best way to measure your success is not by whether you're beating the market, but whether you've put in place a financial plan and a behavioral discipline that are likely to get you to where you want to go. So we love that. We developed this Live Well plan that we talked about. And when doing that, we create what we call our family index number. What rate of return do you need to be, quote, successful in retirement? And this is a personalized number for each family. That it's not just a cookie cutter type of deal, but we're solving for the least amount of risk necessary that we think you need to take to be, quote unquote, successful. So we'd be happy to create a Live Well plan for you. There's no gotchas, no catches. We do this on a complimentary basis. And our only promise is we think you'll leave a more educated consumer by going through this process. And for a lot of people, we're asked, well, what questions should I ask an advisor if I am interviewing you and someone else? Here, this is our best way of being kind of transparent. Here would be what we would recommend. Are they a fiduciary? We think that's big. Are they representing you, or are they representing a bank that they work for or a brokerage firm they work at? Do they have a transparent cost structure you can understand? We think it's important to have a couple of CFPs on the team, certified financial planners. Do they have experience? But at the same time, you don't want to, if you're 62 looking to retire in the next year or two, you don't want to hire someone that's your age, because just as you're thinking about retirement, they also are thinking about the same thing. We think it's really important to have a succession plan put in place. Is there a niche, or are they just a generalist? A lot of people in our industry, they just will, if someone's retired, they'll help with retirement. If someone's just starting out in their 20s, they'll help. But we think it's worthy of consideration to have someone focus on the niche that you are in or about to enter of retirement. And you want this to be personal. You don't want someone who you feel like you're just a number to. You don't want a cookie cutter investment program where they're just going to throw you in with everyone else. You want something that is personalized for you and your family entering your golden years. And low client to advisor ratio, this is important. Here at the Price Group, we have anywhere from a third to a half of the less than the quote unquote average of how many clients each advisor has. So we take this very seriously, and we're always going to be overstaffed on human capital for our clients. But yeah, if you want more information, shoot me an email. Happy to send you our 10 questions you should ask every financial advisor if you're just starting to kick the tires on considering to look for a few teams to interview. But with that, I want to say thank you from Randy, myself. This is the rest of the team as well, Maddie, Tiffany, and Melissa. We take great pride in what we do, and we're not going away anytime soon. This is where we have hung out for a couple of decades, where we're going to hang out for quite some time, and we would welcome any questions on your personal situation, any just macroeconomic questions that you might have, and would love to put together a Live Well plan if that ever is of interest. So with that, I want to say thank you for your time. We are just a few minutes ahead of schedule, and please, like I said, send us an email with anything offline if need be. Thanks. Take care. Bye-bye.